Have you ever watched the stock ticker and wondered how some people seem to always know when to buy or sell? The market can feel like a chaotic, unpredictable beast. But what if I told you there's a method to the madness? Welcome. Today, we're not just talking about investing. We're going to unpack the core strategies that turn you from a market novice into a savvy, disciplined trader. Whether you're a complete beginner looking for stability or a seasoned investor looking for more advanced tactics, this video breaks down every trading strategy explained. Let's dive in. 2. Day trading. What to include. Definition, key principles, techniques, scalping, momentum, risks, rewards, actionable tips. First up, the fast lane, day trading. What it is. Day trading is all about making profits from short-term market movements, specifically, buying and selling a security within the same trading day. You're aiming for quick wins, but the stakes are high. Imagine buying a stock in the morning and selling it just before lunch. Your goal is to be flat, hold no positions, by the time the market closes. Key techniques. The most common methodologies here are scalping, making dozens or even hundreds of trades a day, trying to capture tiny profits on minimal price changes. It requires intense focus and rapid execution. Momentum trading, identifying stocks that are moving strongly in one direction, up or down, and jumping in to ride that wave until it loses steam. Tools and risk. You'll need a reliable broker, fast execution, and charts with small time frames, like 1-minute or 5-minute charts. The risk is significant. A small mistake can lead to large losses quickly. The reward, however, is the potential for consistent daily income. 3. Swing trading. What to include. Description, time frame, techniques, chart analysis, platforms and indicators. Next, we slow the pace slightly with swing trading. How it works. Swing trading allows you to hold positions for a few days to a few weeks. Think of it as catching the wave. You're not the surfer riding every ripple. That's day trading. But you want to ride the main swell of the price movement. Strategic approach. The heart of swing trading is technical analysis, chart analysis. Swing traders look for specific patterns, support and resistance levels, where a price is likely to bounce or break through. Moving averages, to identify the general trend direction. Indicators like the RSI, Relative Strength Index, to determine if a stock is overbought or oversold. This strategy is a great compromise, offering more time to make decisions than day trading while still actively engaging with the market. 4. Position trading. What to include. Long-term focus, fundamental analysis, less stress costs, ideal assets. Now let's talk about the long game, position trading. The long-term view. Position trading is like planting a tree. You need patience, but over months or even years it bears fruit. Position traders hold on to stocks, ETFs, or other assets for months or even years, riding out short-term market volatility. They focus on the big picture. Fundamental analysis. This strategy relies heavily on fundamental analysis. This means evaluating the intrinsic value of a company, things like its earnings reports, its competitive advantage, the overall health of the industry. The benefits? Lower stress and lower transaction costs because you are trading infrequently. Ideal assets include strong blue-chip stocks and established ETFs with long track records of growth. 5. Algorithmic trading. What to include. Definition, how it works, types of algorithms, coding basics, complexities. Time to look at the future of finance. Algorithmic trading, or algo trading. Defining algorithms in finance. Imagine writing a robot to buy your favorite stock every time it hits a certain price. That's the beauty of algorithmic trading. It uses pre-programmed computer instructions to execute trades at high speeds, often faster than any human can react. How it works. The algorithms are based on a simple set of rules. For example, if stock X's price drops below its 50-day moving average, buy 100 shares. While the code can get very complex, the core logic is often just a series of if-then statements. Example, simplified Python logic. If current price, historical low, execute buy order. Algo trading ensures discipline, removes human emotion, and can find opportunities across many markets simultaneously, but it requires coding knowledge and careful backtesting. 6. Options trading. What to include. Basic concepts, call put, strategies, covered calls, risks, and key terms. Finally, we arrive at one of the most powerful and misunderstood strategies, options trading. The reservation analogy. Think of options like a reservation for your favorite restaurant. You pay a small fee, the premium, to secure a right to buy or sell something later. A call option gives you the right to buy a stock at a specific price, the strike price, before a certain date. A put option gives you the right to sell a stock at a specific price before a certain date. Key strategies and risks options offer tremendous leverage. You can control 100 shares with a small premium, meaning profits can be magnified. A common beginner strategy is the covered call, where you sell a call option on a stock you already own to generate income. However, options involve unique risks. If the option expires worthless, you are out the entire premium you paid. You must know your Greeks, delta, gamma, theta, before diving in. 7. Scalping, what to include. Essence of scalping, timeframes, quick strategies, psychological aspect. Let's zoom back into the fastest pace of trading, often considered a subset of day trading. Scalping. The essence of scalping. Scalping is like a game of whack-a-mole. You're not aiming for a huge market move, you're trying to snatch tiny profits from fleeting price movements, sometimes just a few pennies, multiple times a minute. You need to act fast, 1 second too late, and the opportunity is gone. Tactics and time frames. Scalpers use extremely short time frames, often 1 minute or even tick charts. The strategy relies on high trading volume and a tiny spread, the difference between the buy and sell price. The key here is volume and repetition. A scalper might execute 50 to 100 trades a day, aiming for small compounding gains. Psychological readiness. This strategy requires intense focus and iron discipline. It's not for the faint of heart. You must accept small losses instantly and move on to the next trade. If you hesitate or let a small loss turn into a big one, scalping will quickly destroy your account. 8. Risk management strategies. What to include. Important stop-loss orders, diversification, position sizing, practical techniques. Now, regardless of which strategy you choose, day, swing, position, or algo, the most crucial element for survival is risk management. Your safety harness. Think of risk management as a safety harness on a roller coaster. It keeps you secure while allowing you to fully enjoy the ride. You could have the world's best trading system, but without risk management, a single bad day can wipe you out. Practical techniques. Here are the 3 must-use tools. Stop-loss orders. This is an automatic order placed with your broker that sells your asset if the price drops to a predetermined level. This caps your maximum loss on any single trade. Never enter a trade without setting one. Position sizing. This dictates how much money you commit to a single trade. A common rule is the 1% rule. Never risk more than 1% of your total trading capital on any single trade. For example, if you have a $10,000 account, your maximum loss per trade should be $100. Diversification. Don't put all your eggs in one basket. Spread your capital across different assets, sectors, or even different trading strategies to protect your overall portfolio from localized shocks. 9. Conclusion. What to include. Recap key points, reiterate strategy selection, invite viewer engagement and continuous learning. We've covered a lot of ground today. Now that we've unraveled every trading strategy explained, from the lightning-fast scalping and day trading to the methodical position trading and the specialized worlds of algorithmic and options trading, what's the most important takeaway? Remember, the best strategy is the one that fits you. Are you patient and analytical? Position or swing trading might be for you. Do you thrive in a fast-paced environment? Day trading or scalping might be a fit. Your strategy must match your personality, your time availability, and your risk tolerance. Keep learning, keep trading, and most importantly, stick to your plan and manage your risk. Tell me below in the comments, which of these strategies are you going to research first? Don't forget to like this video and subscribe for more deep dives into the markets.